Hola everyone and welcome back, educator and entrepreneur, La Maestra of Insurance. Today we're just going to discuss some things that you are definitely going to need to know before you even start your study material. Let's go. The first thing that you are definitely going to need to know is insurance. What is that term? Insurance is going to be termed as the transfer of risk. We all know that everyone living needs financial security in the event of a loss. So the insurance company is saying, hey, we are going to transfer that risk from you to us. We are going to pay out in the event of a loss to give you that financial security that you need. Another term that you're going to need to know is the insurance contract. The insurance contract is the legal agreement between the insurance company and the individual who's covered on the policy. What this means is that the two are agreeing to both do something. The insurance company is saying, hey, we are agreeing and promising to pay in the event of a loss. So they're going to pay out what is also called a claim. And this is legally binding. So this means that by law, the insurance companies have to perform these promises within the contract, okay? As long as you or the individual who's covered on the policy makes those premium payments for that policy to stay in effect. There are three principles that we're also going to discuss today. These could be termed the three important principles of insurance. The first one is called risk pooling. So what this means is that there is always a chance of loss occurring, right? So what happens is instead of one person being responsible for that loss, there is like a pool and everyone is putting into that pool financially, and that risk is then shared amongst more people. So I want you to think about Medicaid. If you work, then you know whether you want to or not, funds are automatically taken out of your check and given to the Medicaid. So that means whenever someone files a claim or they need Social Security benefits, they have access to that because we're all putting in small amounts of money to help pay out someone's claim. And so if it need be our turn, those claims are then going to be paid from the same pot, so to say, of funds. So insurance works the exact same way. It's just transferring the loss of one person being responsible for everything to basically everyone pitching in and helping to pay out claims. Just think about if we didn't do that, then the insurance companies most likely would not be able to pay out everyone that needs those funds, all right? The second principle is going to be law of large numbers. So this is where the insurance companies are saying, hey, we know losses occur, but what we need to do is we need to narrow it down to figure out typically how many losses are occurring within a set year. So what they do is instead of predicting, they hire individuals who are called actuaries, and these actuaries actually go out and collect and analyze the risk data to determine what these numbers and the rates of individuals passing away are. And that's going to be your mortality, which is the rate in which people pass away, and then your morbidity is the rate in which people get sick, because we know that insurance pays out when you pass away, but also if you didn't know, your insurance can also help you when you become sick. All right. So the law of large numbers looks at a group of individuals. And again, they are looking at individuals who have similar risk. So let's say that you have 1,000 individuals who are smokers within 30 to 35 for 2024. They're going to look at those numbers and see how many of these individuals passed away and then how many of these individuals got sick. And that's how they go off by saying, okay, well, next year we should look to pay out such and such number of claims to this group of people. The third principle is going to be insurable interest. So insurable interest is essentially saying, hey, what is my concern financially for the well-being of this individual, or what is my financial obligation to this individual when they pass away? All right. So insurable interest must be made upon the application. So anyone wishing to buy insurance on someone else has to provide proof of insurable interest for the other person. So let me give you an example. So let's say that you have a spouse, and let's say her name is Sally. Sally is trying to get insurance on her husband, Tom. The agent would ask Sally, okay, what is your relationship or your insurable interest to Tom? Sally is his spouse. So let's say that something happens to Tom. Sally will be the one financially responsible to take care of the whole family by herself. So she has a financial obligation to Tom when he passes away. Insurable interest has to be made upon the application. So as soon as you sit down with your client, you're going to ask, who are you covering and what is your relationship to them? So in order to just have like a basic business understanding of what insurance is, there's a few terms that are going to have you memorize, all right? So one is indemnity insurance. So indemnity insurance is insurance that is compensating the beneficiaries, all right? So think about once someone passes away, we know that we can never bring them back, and we know that their life is not worth monetary value, but it does help to financially restore that individual's income. So we are making it whole again. Now, again, we're not substituting a life for money, but what it's just saying is financially, the insurance companies are going to make it whole by giving the beneficiary the necessary funds that they need in order to continue on with life once that individual has passed away. Another term that's very important to remember is premium. So premium is going to be the amount of funds that are paid for the policy, all right? So always remember that premiums are always going to be paid by the individual or the policy owner in order to make sure that that policy stays in effect. And so that way, whenever there's need for a claim, that claim can be paid out. Another term is going to be claim insurance, and this actually applies to all lines of insurance. This is when the insured, so the individual that is covered on the policy, sends a notification to the insurance company that a payment is requested for a covered loss. So claim is something that you are definitely going to see on your exam. Another term is adverse selection. And this is a tendency for individuals who are poorer than average risk to actually try to seek out insurance. We know everyone wants to be covered, but the insurance companies have to minimize the adverse selection. So think about it like this. If everyone could get insurance, no matter their health condition or when they would be passing away, most people would. So if you had someone who was getting ready to pass away within a few months, they would wait to get insurance until that time, and they would probably pay a few months of a high premium, but they know that their family is going to receive a huge payout within a few months. If everyone was able to do that, the insurance companies would actually go bankrupt. So this adverse selection is actually put into place to just minimize some of those individuals who have a poorer risk than the average person, and just really say, hey, we are going to insure you, but you're going to essentially have to pay higher than the average person due to your higher risk. Thank you all for watching. Don't forget to like and subscribe so that you can always get the latest tips on how you can master your exam. Until next time, hasta luego.